mean, listen, the market didn't know what it wants to do, was it? Yesterday, down heavy. Today, bouncing back up. The S&P 5, give me a quick sound check, by the way, guys, regulars, if you can, and you hear me all right. S&P's sitting barbed wide doing nothing. What surprises me is the fact that the FTSE of all things, is outperforming everything, just marching on and marching on. So you FTSE traders are finally getting, some joy from stuff. So yeah, not much is going on. Obviously, yen's weak today. I say not much is going on. There's still reasonable volatility and excursion, right? The ATRs are still pretty high. You look at the average trading range; it's come down a little bit, obviously, from the sort of February dip, but it's still reasonable. We just have one day down, one day up, one day down, one day up, one day down, one day up, which for you range guys, perfect. You're sitting there, resting bids, getting filled, scaling out the top. Yeah, it's working all right. As I said before, and I'm still saying this, I want to see this resolve. I'd love to see it resolve, see where we go, see where we head. There's lots of kind of news flow and bits and pieces that potentially are going to influence this, but they haven't really yet. So keep your if it's working for you, great. If it's not, keep your powder dry. Don't push stuff. There's no need to. Thank you, Lana. Thank you, Marinus. Thank you, Lee. Thank you, Leslie. Thank you, Lee. Thank you, George. All right. A quick scan of who we have in the room, and I want to give you a little bit of a Arthur's here. Amar's here, Alison's here twice. You might get the echo, Alison. Andy's here, Anne's here, Anthony, couple of Anthony's, Arta, Bettina, Chris. I'm skipping through, I'm missing a few people. That's not personal. David, Dominic, Errol, George, John, Lee, Lana, Leslie, Luke again, another Luke. Luke is the most popular name today. Marinus, Mark, Neil, Patricia, Patrick, Paul. I'm skipping through. Apologies if I missed you. Rhino is back in the house. Robert, Rodrigo, Ruben, Simon, Sue. Good to see you, Sue. Toby, Xerxes. And anybody I've missed, I apologize. You'll still appreciate you being here. All right, so we're going to get started. Risk as a dynamic variable. First of all, if I may, great little book, this, The Playbook by Mike Bellafiore. He's the co-founder of S&P Capital. So, he deals with traders a lot. He's never been around a lot, 20 years, I guess. They've been nurturing traders, coaching traders. But they operate the traditional prop firm model, which we used to do in the old days, which was you would have, I don't know if they rent a desk, but the old London days, you'd rent a desk and then you get a profit split. And you get access to lower commissions, you get access to tools, and you get access to data feeds and stuff. Of course, the game's changed now. We can get that at home, but this is similar to what they do. They're looking for traders who are exemplary, and they're making money from the traders as opposed to the current prop model, which is slightly different, as we know. Anyway, enough of their business model. Little comment here. There's some stuff I really want to share with you, but I don't want to go on for ages. Great book, worth reading. I know they do trade stocks, and it's all about stocks in here, but I think it's regardless of which asset class you're trading, right? So here's an exercise that Mike did. I'm going to paraphrase a little bit because I don't want to make it too long. He spent 6 months standing behind our most promising traders, focused. I'll just say as it is, right? I spent 6 months standing behind our most promising traders, focused solely on them being big in their best trades. I didn't care if they lost. I was only concerned they were big when it mattered. Coaching is one of the most effective ways to make a trader better. Pushing him to get bigger is very effective in real time, is a very effective way to get people trading bigger in their best setups. You are forcing them to be bigger and experience that trade. One thing to be careful about as a coach is not to get the trader into trades that you would size up in, get them into trades that they want to size up in. Many traders want to get bigger. Intellectually, they see where they want to add size, but they just cannot execute. And you have to work on this with them, just like you do explaining an opportunistic setup. The first step is learning, then the next step is executing. So whilst that's about getting bigger and increasing size, which we'll touch on, it's not exclusively what we're talking about today. We're talking about risk as a dynamic variable, which includes reducing and increasing size, and not just on bigger plays, the kind of textbook type of stuff. We're going to go into a little bit more depth today. A great little quote here from old Stanley Druckenmiller, one of my prefer traders to listen to what he's saying. He's a macro guy now, of course, but mindset's still the same. When you see an opportunity, go for the jugular. Again, with the theme here of going bigger, we're not, I promise you, it's not all about sizing up on best plays here. There's more to it today. We'll see when we get going. So first of all, just I get the risk out of the way. Let's get the risk out of the way. Shall we get the risk out of the way? Of course, you know this by now. If you're new here, maybe you don't. 30 seconds of your time, just making sure you stay safe. Because if you're trading with spread bet, you're trading with CFD, you're trading with leverage, you're trading with margin. To be honest, it's the same if you're trading a futures contract, any other asset class. Well, not necessarily if you're trading directly on a cash account. But today we're going to talk about people, talk to you, and you generally probably going to be trading with a leveraged instrument. So just be careful. There's a high risk of things going wrong. We're trading leverage because we want to tilt the odds in our favor, but we also can't ignore the fact that we're going to have losing trades. Things aren't always going to go away. So we have to manage risk, have to be aware of the danger that comes with trading leverage. It's, double-edged sword. Sometimes it works very well. Sometimes it works against us. But just really understanding and appreciating the product and the instrument you're trading, whether you like to trade that, whether it's the right vehicle for you, whether you're trading with money that you're happy to lose, all that type of stuff, right? I know I say it and I repeat it, but I want to make sure that no one's going in saying, oh, I saw this video over here on Instagram, this guy was doing this, and I went in and I lost money, didn't realize what I was trading. You know this already, guys. You're here, you're experienced, I'm assuming you are, but many people aren't. Sometimes watch recordings, sometimes joining the webinars for the first time. If you are, welcome, hello. But please just understand the risks. It's not all upside. The upside is great, but there's downside to manage as well. Brief introduction. My name is Mark Holstead, here to help you improve your trading. Been around for 20 plus years, 25 now, in about, you know what, actually 25 in about a month, technically speaking, 25 years. I have to double work that back, my first trade. Anyway, regardless, who cares about individual years and who cares about me? The perspective I come from is to try and help you with trading from my experience and from working with other traders, seeing other traders develop, helping other traders get really good, seeing other traders struggle, and everything in between. And I try and get those bits that I think are valuable to you, depending on what you're trading, regardless of what you're trading, should I say, time frame, asset class, ability, time you've got available to spend, all those other variables that we talked about before, and really try and kind of push that knowledge, and hopefully you can grab what's valuable, discard the stuff that's not. I'm not expecting you to every webinar to hit perfectly, but you can take out one or two things that helps you trading. You're just moving forwards, and it's just moving forwards, staying in the game long enough to get it, is what Linda Rashke has said before. Maybe I'm paraphrasing a bit. That's pretty much what she said. So let's recap quickly, and then we'll get straight back into the thick of stuff. Not much to cover markets wise today, so we'll go straight in with the valuable insights, if you like. So far, January, on this 12-week traders operating system that we're covering, in January, we talked about strategies. We talked about mean reversion. We talked about news trading. We had some setups for that. We talked about trend trading and momentum models. We covered loads of stuff. The idea was to fire lots of stuff at you, give you some resources as well, to if you're struggling with strategies, to maybe be inspired by one or two of those. That was the game in January. February, we talk about selecting the strategy for you. So if you're a part-time trader, you've got a job, you've got a business, you're trying to do other things, then we talked about adjusting and picking the strategy that suits you from that perspective, from your skill level, from that perspective, from your emotional and from your personality, fast action, patient, all the stuff that's hardwired to you and your brain, and the man or woman that you are, trying to adjust the strategy to suit you for that. It's all very well learning a strategy from YouTube and whatever, but if it's a real mismatch with the time you've got available, your resources, who you are, it's never going to work. So we covered that, and then we talked about looking into losses and learning from losers and how we adjust and adapt from that. And today, the final part, and we'll talk about March at the end. I'll give you insights into what we're going to cover then. But today, we're going to connect it all together with the one common denominator that is there regardless of what you trade, when you trade, how you trade, the size you trade, which is the risk you are taking. And so let's get rolling. So the big idea I've got for you, is this. Let me just clear my desk. I've got books on there, notepads, all sorts of, there we go. Get rid of that mug. Don't want my NASDAQ mug. Don't need that, do I now? It's empty. Right, big idea. So most people think about risk just going up when you size up. And we talked about the playbook and at the beginning, Stanley Druckenmiller, and obviously there's a certain aspect to that. That's correct, right? If things are going your way, then you want to try and do more. And the objective of that is if it's working on a smaller size, can you increase the size as much as you're comfortable with risking to get better returns? And that's the objective of sizing up. Of course, we will understand this. There's other ways to use risk and to use size. And so today, I want to cover different ways that we can use risk or size, interchangeable things really, as a tool, depending on the situation we're in, depending on how we're feeling, all this other good stuff. So, rather than just thinking more size, bigger trades, which is fine, it definitely plays a part, we can do a little bit more. So I want you to sit and consider for a moment that risk is a dial. And I'd like you to step back and think that you are the kind of CEO of your trading business, right? You are taking this seriously. Listen, if you're here watching me, you're taking it seriously enough to spend 45 minutes, an hour of your time learning. You're probably serious about this. You're not flicking through shorts or TikToks of people with doing all sorts of stuff. You're interested in developing and learning, and you appreciate that there's a time sink in here, and you might get loads out of it. You might get a little bit out of it. Hopefully, you get a lot out of it. So think about how you trade, right? And imagine you're the CEO of your business, and you're adjusting. Risk is an adjustment you can make, and you can turn it down, you can turn it up. In other words, this could be on a per trade basis. It could be on as a sizing per trade. It could be on a per day, per week. You can adjust that, and we don't need to go into minor details about that and go really, really deep. But that's what I want you to visualize in your brain. It's like this dial, and we can adjust that dial in response to 4 things I'm going to suggest to you today. Number 1 is emotion. Number 2 is your performance. Number 3 is the market regime. And number 4 is your trade setup. So we're going to go through all those and different examples and scenarios of how to use risk as a tool, not just a sizing up tool and getting bigger and trying to increase your return if you've been doing, had a history of doing okay. So let's start off with basics. Everyone knows this, right? Risk is you have 100 points stop on the market, you do £10 a point, you risk is £1,000. If you've got a target 200 points, your risk is 2 to 1. This is just a standard maths and a standard risk. But we can think of it in a slightly different way. In that maybe you take a trade with those metrics, 100 point stop, 200 point target, simple 2 to 1. You £10 a point, you're risking £1,000, you want to make 2, that's how you're structuring it. You don't know how the outcome is going to be, but let's just simplify it all for now. What's often missing from that basic calculation is other things, variables that as a genuine trader, you're in the trenches every day or every week. You know this. You don't feel the same for each trade you take. Your head might be elsewhere. You might be anxious about something outside of trading. You might be frustrated about your recent performance. You might be frustrated about a loss you just had 10 minutes ago, 3 minutes ago, 30 minutes ago, right? That's going to impact the efficacy and potential outcome and positive expectancy of that trade. And we're assuming that trade that example has a positive expectancy, and you think it has, you might know for sure, depending on how much experience you've got, but that's where you're taking it, right? Now, that's the psychology side of stuff. But what about the conditions? It might be a classic pullback to a break and pullback, breaks out, pulls back, does a little pin bar through a level. Great, you have a stop there. But the conditions vary from day to day. If it was sitting in a choppy range like we're doing now in the S&P 500, you might be like, well, we've kind of not done anything yet. Versus when we were bouncing off those tariff lows and it was a pullback to the buy side, and you might be like, okay, well, the regime looks better, the conditions look better. We've done sort of gone more depth on context and other things like that to come up with a context, understanding that really helps the trade. But context is different from day to day. And then we've got the actual setup. So the structure might be the same. It might be a breakout, pullback type trade, but is it at multi-month highs? Is it after a catalyst? Is it after we've already trapped a lot of shorts to the downside? These are real powerful extra weight to the trade, as opposed to where it's just broken out of the kind of 15-minute high pullback. You might say it's still value, you might want to take it, but it's very, very different, right? And so these are some of the things to consider when we're trading in the real world like you and I in the real world, actually executing, actually taking trades, feeling the emotion that comes with that, seeing the difference in price action, understanding the nuances and the little tiny tweaks and stuff that you just can't get from, you know, a textbook or, you know, someone just picking out a chart pattern and going, oh, I would have bought here and there. There's a subtle difference there. You and I both know this. And so we should consider, and by the way, you don't have to go into the email. Listen, this is too much information, too much. I don't want to vary my risk. But it may be something to consider in the future. If it's not something you're doing now, it might be a tool that you can use in the future. It's a very, very powerful tool. And to visualize this, just think, you know, well, you've done it before. We've all done this and probably been on the wrong side as well as the right side. You've sized up on a play that hasn't worked and it's wiped out way too many days of your games. You've sized up on a play and it has worked and it's given your equity curve a big boost. Same with sizing down, like you've done less damage. So you know that you can still trade exactly the same way, but you can add this extra layer of risk as a variable in, and it can change the output of those setups and those trades and those sequences in massive amounts either way. And we're trying to, basically what we're trying to do here is we're trying to reduce the damage when we're not in tune, when things aren't in our wheelhouse, when the regime's not as good as it could be, and we're trying to increase it when things are working. Now, just like SMB and Mike was saying there, he was focusing exclusively on getting bigger on the best plays. That's that fourth one there. The setup is a grade A play, and they're ready to rock. I'm getting ahead of myself a bit here, but hopefully you can kind of see how we're mapping this all out, guys. Okay, so a quick word on the pros and cons. There's a downside to this. As always, by now, you know, the market gives one hand and takes away. There's always this balance with everything we do. You know, if we try to get a high risk reward ratio, then we know that the probability of success naturally goes down. The chance of the market, probability of the market going 100 points is way higher than the probability of the market going 200 points or 400 points. So we understand that we're still trying to pull those two levers. There's the same with this, right? And the same with everything in markets. And this is always the game. We're kind of judging and if you're like me, you kind of go through life sometimes going, oh, what's the risk reward of that? What's the risk reward of that? You're like, come on, hang on. This is the real world. It's not a trade. So adjusting risk, pros and cons. Now the cons are, let's start with the downsides. You are adding an extra layer of decision making, right? And you do have a potential for it to pollute your results. If you're using a fixed risk throughout everything you do in trading, we're going to talk about all sorts of different scenarios here, set up blocks, whatever it might be, then you just have a smooth, there's nothing to consider. The results are the same on each trade you take. The R multiple is the same. Sorry, the R unit is the same. Risking £200, say it's going to be £200, whatever trade you take. Pull back this, that, the other regime, whatever you're feeling, and that's fine. Okay, and adds a layer of simplicity. And the downside is that you are adding a layer of decision making. You are potentially polluting your results. Now, if we look at the upside, I think that this allows you, if you're the right trader and this is kind of something you consider working on, it allows you to adapt to changes in how you think, your trading psychology, your mindset, and the conditions quicker. And I believe this is where you should head to as a trader. Maybe you're not quite there yet and you're kind of lining some bits out. Disciplines maybe not quite on point, and strategies a little bit loose. Prep needs dialing in, confidence need building. Fine, all those things need building up as well. But maybe it's something to consider, because you know, if you can get this right, you can really help limit the damage of your drawdown. And you're never going to get perfect, right? I'm not going to say, oh, you're going to be on the smallest size trades when you're worst. It's never going to work like that. But if you can kind of time it like this, you can just improve things without doing much else with the setup, I guess is what I'm trying to say. So let's consider two examples here, or two types of drawdown, right? I always think of, there's two banks, right? You've got the kind of the emotional bank, and then you've got the financial bank. And you've got your account balance, your equity curve, and all the things that come with that, your P&L. And that goes in the financial section. And then you've got your emotions, you've got your psychology, and that the confidence that comes with, you know, any of the unique emotions that we feel as traders, like the FOMO, revenge trading, all this stuff. And, you know, that can be drawn down as well. Confidence is drawn down, confidence not feeling very, very good. And so look at these two and think of them separately. So for emotional drawdown, and we've all been here, right? If you've been trading for any period of time, you've been in a situation where you just think, you know what, I'm not really, I can't feel like I'm second guessing stuff here. Should I do this? Should I do that? Your confidence is in on the floor, and something's just off. You just feel it, and you're not pulling the trigger when you should. You're kind of trying to find trades that you believe are easy trades, and so you're waiting for kind of breakouts with confirmation, and by that time it's already done, and you're not being brave enough to buy on that. All this type of stuff. You're second guessing, coming out too soon, nervous about trades, and it just screws with your P&L. We've talked about this many times before. I'm sure we'll explore it again because it's a big thing, and it's affecting your execution. So an easy lever to pull is just to make a minor adjustment on your size, right? If you feel it, that's enough of a signal. Now, some of you might go, I want some data, I want to go back, I want to look at this, I want to look at that. Fine, I'm not going to say don't do that, but I'm a big believer in discretionary trading, of kind of guiding with rules and structure and then adding a layer of discretion onto it. I believe my edge comes from experience and judgment, and the discretion part of it is the big bit, and I think you maybe consider that too. So if you feel a lack of confidence, there's nothing you can do. You can say, oh, I'm going to do this, but if you feel that, fine, you're going to take steps to improve your confidence. But let's be honest, most of the time that comes with executing and P&L and performance. And the trouble you have is when your confidence is low and you still keep hammering away with your normal size, doof, 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 it actually exaggerates and amplifies the impact of that confidence drawdown. So something that I've found effective, and maybe you will too, or maybe you do this already, is to just trim a little bit. Now, this is different from sizing right down. If you make a commercial decision to size right down, fine, go ahead, go for it. This is more of a token gesture to make you feel like you are doing something proactive. Okay, there's a subtle difference. One is, okay, I want to actually make sure I'm trading awful, I'm going to trade half size. Fine, you do that, and you can do that, and that's an absolute correct tactic. This is something else where you say, hey, I'm only going to reduce the size by 10%. I just want to play a little bit more defensive. And that's not going to make a massive impact, but that changes your psychology, because the next trade you take, if it's a losing trade, you will feel slightly like, well, I kind of thought I might have a losing trade because that's why I knocked down my size. And so this becomes a more of a proactive thing for the mind, that you say, hey, I feel like I'm doing something. I'm taking this seriously. My confidence is in the toilet. I need to recover that. But whilst I'm doing that, I need to limit my damage. Now, if that 10% is 25 or 50, you do whatever you need to do. The issue you have when you scale down, if you feel a lack of confidence all the time, is you're constantly going boing, 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 and your size is adjusting way too much based on emotion. And I don't think that's good, because we all know what happens. You start, I'll do a half size, then all of a sudden you start smashing out the park. We've talked about different regimes, we've talked about different conditions, we've talked about execution slippage. There's all sorts of variabilities why you might have a losing streak. But if you feel, and that's only you can measure that you have a lack of confidence, do something about it. And if you don't want to dial down your size because you think, well, actually next week I can have a really great week and I'm going to be half size, it's going to take me even longer. I get it. There's a perfectly reasonable pushback on that. Then just do a small size as a gesture to say, I'm taking this seriously, I'm doing something proactive. So that's in confidence drawdown, using size of the tool, saying, hey, this is a tool, adjust it slightly, I've done something to help that. Now, the other side of the coin, or fence, maybe a better analogy, it's financial drawdown. One of this, you're losing money and you feel a bit like you're kind of losing. If I can repeat myself here a bit, I think I might have done this. Might be an error in my slides, guys. I'll do it. I can do it free ball, no problem. I can do it freehand. I can do it off the top of my head. So with the financial drawdown, it's the same type of thing. You see the drawdown, your confidence may be high, but this is more of a logical thing to do, where you say, hang on a second, I'm going to reduce the size because actually the numbers are telling me I should. The numbers are telling me that whatever I'm doing, we talked about this a lot last week, and there's no need to go into much more depth. We're going to reduce the size a little bit because actually, you know what? The performance is not there. The numbers on the board aren't showing what I need to do. I need to scale things back because I'm doing is damage here. Until I can analyze, until I can diagnose the problem. Is it a regime shift? Is it an execution shift like we talked about last week? Is it that they're just getting a sequence of losers that are normal? Until I've diagnosed that, I want to reduce the size and go and play a little bit more defensive. Again, it's a proactive decision, and I want to kind of just go, you know what, just calm things down a little bit, diagnose a problem. The problem is that we may be waiting for this news, and I haven't really, or problem is the regime shifted a bit, I've been pushing that side too hard. Again, use it as a tool. It's a tool to be adjusting. And something a lot of traders push back on, which is fair, is they say, oh, I don't want to ever reduce my size. Once I've increased my size, I don't want to go down. It's like if you go into the gym and some guys in the gym go, we never go down a weight once you've kicked up a weight and you're there, you know, like your form's off and you're struggling away on your bench and you've kind of whacked it up big, and it's like, well, you never reduce it and now you've increased it. Like, well, I mean, my form's absolute crap here, man, and I can't even finish my set. It's like, well, you never reduce it. And then someone else comes on and goes, yeah, of course, knock it down, take a plate off and just do a really good set with good form. That's an analogy, but you get the point, right? Same with trading. A lot of traders believe never go back down. I disagree. I think that you do use this as a tool, and you think about a football player, right? He's injured and he comes back. Very rarely he's come out and play a full 90-minute session. He comes back and they bring him on for the last 20 minutes. And so because you've gone back doesn't mean you can't come back on. It doesn't mean you have. It's not a retreat. It doesn't mean there's no big issue here. You're a poker player. Adjust the stakes based on what the table is, who he's playing against, and the cards up and down. No big deal. And a lot, I think amateurs tend to play the same size every time because they haven't considered this as a variable. And hopefully this will help you consider that. Is that if it's a proactive decision to stick with the same size, fine. But you don't want to think like everybody else. You want to think, do I want to adjust the size? The answer might be no. I'm happy to keep the same size. That's fine. But I urge you to at least think of the decision, even if it's not, I'm going to change stuff up. Okay. Oh, I should mention this because I think this is very important. If you're not careful, when you size down, you can feel all nice and comfortable. And you can go, oh, well, you know what? I feel all right at this size. I'll stick here for a bit. Fine to a certain extent, but just remember what you're doing this for. Just remember why you're trading. Now, if it's an actual proactive decision, considered adjustment to your model, fine. Do it, sit there for a while. Just make sure you're reviewing and you have a plan to go back to where you were. It's okay to play defense. It's okay to step back. It's also okay to go off the pitch, but consider, okay, well, actually, I need to, when am I going to get back in? What do I need to see in my confidence? Do I need to feel confident again to get back up? What do I need to see in the performance to push things back up? Just something to consider. You don't want to be the person who's always reducing size. There's a lot of traders out there who were trading bigger size and they've now reduced and reduced and reduced, and they're kind of comfortable there, and maybe they're doing all right. And I turn my thing on mute. Maybe doing all right, but they didn't really have a plan to get back up. And that's okay if it's considered, but don't just allow yourself to drift into it. Consider the decision to stay small because of X, Y, Z. Good, that's the way to do it. But drifting and staying smaller and just kind of being, just be careful with that. You know what I mean, right? Next thing is the third point that we might adjust here is the market regime, right? The market regime might just have shifted. It's a great example now. This year so far has been very choppy on the US indices, very different kind of regime, very different structure. And so, you have to look and say, does the regime suit my strategy? If it does, then maybe you consider, we talked about dialing size down. This is where you go, I'm going to dial size up. Because I think there's a fallacy of, okay, well, we've got this, how many trading days in the year? We've got how many trading days, but it's different for each person, right? Not everyone's trading every day. You got how many trading days you got in a year, in a month, a quarter, your week, whatever it might be, and splitting the risk up into each trade or each day. And that's fine. I think, depending if you're early on in your trading journey, that you should absolutely do that. Don't add any confusion. But it didn't make sense to do that when, if you are in the right environment, you're in the right mindset, it doesn't make sense to risk the same amount as you were risking in a substandard environment when you weren't really the right mindset. It doesn't make sense, does it? It makes sense to trade more. And actually, I believe, and listen, I'm not here to tell you how to trade, adjust size, reduce size, and you don't take my recommendations or my thoughts on anything. I'm never giving you advice. That's not my job. My job is to share things I think could be effective, and you take it or leave it and make your own commercial decisions. But I think that actually it's lower risk, weirdly, to trade more size overall on your best kind of regimes and when you're doing well than is to trade a fixed size. It's my personal perspective on this. If you think about it, it does make sense, because why would you risk the same amount on something that's the market's completely unfavorable to your strategy? Now, I do appreciate it's not easy as it going to market just raises a flag and goes, I'm unfavorable, regime shifted. I get it. I understand. I know that these things sometimes take time, but if you're on form and you're on fire, consider taking a way to think about it is consider borrowing some risk from your future trades. If you risk X amount per trade, X amount per week, whatever it might be, if things are working well for you, if you want to still think, oh, I don't want to risk more than X amount, say I'm going to borrow some from next month. What's my R risk from next month? Will I do this amount of trades? Will I 10 R, whatever it is, right? I'm going to borrow that and I'm going to use it in this month. How am I going to distribute it this month? I'm going to do 50% more size or whatever it might be. You see that? I believe that is more an effective way to make those adjustments than not. And same if the market regime is just not really suiting you at all. It's not suiting you at all. Don't be afraid to go, you know what? I'm going to go down half size, but I'm going to reallocate that later on if I need to, because now you're in this super situation where you can go, regime's great, borrow some from that. Okay, well, actually, I'm not going to borrow from there. Actually, I didn't really trade much size there because I didn't really miss much because the regime wasn't right. I was actually banking that risk allowance for when it was right. Oh, man, end of year is working great. Use that allowance. And what is the allowance? And you work it back and you say this, and this, and then you put it on. And obviously, there's an upside and downside with this, but being proactive to the regime, I think that's the way to do it, and that's my opinion on stuff. Other people would disagree, fine, but I think that if you can, and I do appreciate, again, repeating myself a bit, but it's not so obvious all the time. The numbers and your feel about stuff should be taken into account, and if you need to adjust it. So now we're talking about the individual trade. So that was regime shift, big regime shift, markets in different conditions. The volatility is a bit lower, news driven. Trump tariff was one regime, even though volatility was high, grinding odd trend, whichever market you're trading, gold to blow off top type, whatever it might be, right? Regimes shift and adjust all the time, adjust and adapt to that. Now, let's talk about sizing variations for individual trades. So I think that there are two ways to do. There's probably more, but this is the way I like to think of stuff. One is Mike Bellafiore's way, and SMB do a lot of this, and it's something that I think is a very good way of doing stuff. Is you come up with a grading system for your trades. We've discussed this before, so no need to go into much depth, and you can go check out the recordings for that, and I'm sure we'll address it at some point in the future as well. But the idea of this is that you grade your trades. Let's say A plus A, B plus B, and you never take anything less than that. And you're kind of assessing the quality of the trade, and you're adjusting your size to suit. Now, some people might go, have it 3 times the size on an A plus, and they might have it 1 time the size on a A. They might go, sorry, let's think about it. A, they might go twice size. A plus might go 3 times the size. B plus, they might go 1 unit, and then B, they might go 3/4 of a unit. It doesn't matter how you spread it out. You just adjust size based on that. And we'll talk. I've got a slide in a moment to kind of highlight maybe how we do that. But that's one way of doing it. Individual trades, I think is a good trade. Now, the downside of this, of course, is you don't know if the next trade is going to be a winner. You don't know if it's going to be a loser. You're only taking your best guess and saying this has got the metrics and variables I believe are good and have a good outcome. I'm prepared to take more risk on the trade. Again, your decision, your commercial decision. Another way to do it is not quite as brutal, because of course the impact of that is if you take a trade and you've gone double size, triple size, and it loses, it sets you back by 3 normal trades. So you've got to be careful with this. Another way to do this is to segment your trades into buckets or strategy buckets, right? Or segments. So you have you categorize each one of your playbooks, if you like, into different segments, and you adjust the sizing to suit. So have I got an example of this before I go on? Yeah, I have. Okay, great. I didn't remember if I did this slide. I have to talk about it now, or I can talk about this. So there's 2 ways of doing it: individual trades or segmenting strategies. So I've got a slide for that. Let's go back to individual trades. what does the grade A versus grade B look like? And again, not too much depth here, but just enough, hopefully, to, I don't know, get you excited and get you kind of thinking about this as a possible avenue. Maybe for you, may not be for you. Again, your commercial decision, it's your money, your risk. You decide how to trade this. So a grade A play might be, it's a real high conviction setup. Yeah, it could be, I hate the word no-brainer, but obviously there's no-brainer where you think, I've got to take this. I understand the downside. No-brainer doesn't necessarily mean that there's a guarantee. There's no guarantees, but you're like, I will take this trade all day long, every day. Every time this comes up, I want to take this trade because it has a high confluence. Maybe I see the higher time frame, the lower time frame, the level. Maybe the conditions are exactly what I want. I've got these regime where it's like a perfect regime. Maybe the risk reward is great as well. It's like, oh, I've got this little flush. I can put a stop there. And the chance of, if I'm right on this, is a 10-hour play. The regime's right. I've got a high conviction with this. That might be grade A. Example would be probably one I gave you before, right? If you've got, for me, it's if I've got a catalyst, if I've already trapped some traders, and I'm now seeing momentum ignition. You know, that's broad, but I'd much rather see those three things. See traders trapped, see some kind of catalyst, see some kind of momentum ignition. That gives me a decent potential R multiple. I think that's higher probability than most other trades. And then I'll layer in some technicals with that, whatever they may look like. Now, you might see a technical play that matches that, but hasn't got those three variables. Then that might be a grade B play, right? It's still a play trade you want to take. Reasonable confluence, the conditions are okay, they're fine, tradable. You got a decent risk reward, maybe it's 2-to-1, maybe it's 3-to-1, maybe it's 1.5-to-1, whatever. Decent conviction, you want to trade that. You still want to trade it. You believe there's positive expectancy there, but it's not quite the same. And you and I both know that you can probably picture in your mind trades that you go, oh, I really like a trade. Now you would adjust your size based on that. And this is just be doing two different ones. And obviously you can do as many as you want here, but you're saying, okay, I'm going to trade this one with double size and this one with R unit, 1 R unit, and this one 2 R units. So let's say your R unit was £200 for argument's sake. £200 risk on this one, £400 this one, £20 risk, £40, 20 grand, 40 grand. If you were doubling it, or you could do half, you could do 100, 150. You know what I mean? You can adjust. Hey, so you adjust your size depending on the quality. You believe the quality of the play. Now, understanding you don't know for sure, you're trying to make a judgment on that. And the idea of this works is that you're going to be, as Mike Bellafiore said in there, bigger on your best ideas, your best plays. And if you can get it right, that's when you can make those kind of exponential moves in your equity curve. But if you get it wrong, of course, you understand the downsides that come along with that. All right, so segmenting strategies. So you might have 3 buckets. I'm using these as an example, easy ones to kind of visualize in our brain. A pullback to a VWAP, right? That's one setup. So you kind of see the market pulling back to trending up higher, pulls back to a VWAP, bounces off. You like to take a pin bar there. There might be different variations, maybe like a double kiss, maybe like a momentum ignition off, whatever it might be, but it's a pullback to VWAP segment or bucket. You might have a multi-day breakout trade, self-explanatory. You might have an opening range breakout trade. And you adjust the risk profile and allocation of capital to each. So 1 R unit on a pullback to VWAP might be, this use the same numbers there, £200, let's say. You might think a multi-day breakout has much more weight to it, it's much more positive expectancy. So you might allocate your R unit as £300. So you're still trading in R units, but your allocation is different. And the opening range breakout, you might say, okay, well, I still think that's pretty decent. I'm going to give it a 2 R unit or 3 R unit or 1.5, whatever it is, right? You get the idea is that you're allocating different resources to different setups and you're bucketing it rather than looking at them on an individual level. Because at an individual level, you do add more cognitive load. Let's go back. You do have more cognitive load, so I appreciate that that's not always something you want to be doing in the moment, depending on the time frame you're trading, etc. So one way to do it is to bucket them into these things, and you say, hey, you know what? These are great trades because they have this, and I do much more risk. I take much more risk on these trades versus these trades. And you can sit down and iron this all out, because ultimately I still think that it doesn't matter where the risk is allocated. You just want the risk to be sure. Like, okay, this is my risk, is my drawdown limit on the month. How do I chunk that off into what I'm trading? You know, some traders say, hey, I've got to go really, really heavy as much as I can on these plays because they're really perfect for me, and I understand that it might not work, but I'm prepared to take the upside and downside with that. Other traders go, I want to make a little adjustment. Other traders want to keep it flat all the way through. It's fine. There's no right or wrong. It's finding what's right and what's working for you. So have I got a... Yeah, okay. So one thing to point out here, I'm just, after that slide error, I'm like, did I put that slide in? I'm sure I put that slide in. I remember typing it out. No, I did. So I'm just making sure. I need another screen with the next slide on. So one thing to think about here is, and I've spoken to a few traders who think like this, and maybe it's you, is that we're not just increasing size for financial purposes, right? So the increasing size would be, the logic goes, well, I've done okay with this size. I'm going to increase my size a bit because I want to make more money from that. Understanding the risks involved in that, of course. Sometimes you're in a situation where you're trading size that you really don't care about. And ironically, it makes you a worse trader. You get what I call demo account itis. We all know a demo account is useful for just getting used to the platform. The uses for it. It's not you want to get yourself live ASAP because you have to have skin in the game, because there's a different emotion to it. You know it, I know it, right? So that also bleeds into position sizing. If you're trading a size where you really do not care, it's almost a demo. For a lot of people, 10 quid, it doesn't matter. It's like it's nothing. They spend that on a beer and a coffee, a couple of coffees or whatever, and it's all relative to who you are and everything. But the point is, you're like, well, it's like a demo. It's like a demo. And so, and again, that money there doesn't matter. It doesn't matter whether that's £1, whether it's £100, £1,000. It's relevant to you, and it's got. I believe you have to actually have enough that you feel like it makes sense. Now, sure, if you're learning, you're scaling stuff back, there's a reason. You're just trading small, but you don't want to scale it. And this, again, my opinion, you make your own risk decisions. You don't want to scale stuff down so much that you don't care. You want to care. You want to actually have enough skin in the game that you care about the execution, that maybe it does sting a little bit. You know what? And so you think, you don't just go, oh, what the hell? It's only 50 quid or whatever the number is. I just have a go. You want to be caring enough that you're concentrating, you're focused. You feel like it's worth putting in that effort and those resources into that trade and that day, because actually the outcome is going to be something. And again, I understand it's a balance, right? Not going too far that we're kind of worried about the size and we're trading more than we're prepared to risk, all that stuff. No, that's a foolish game to play. We don't want to be doing that. I'm talking about the other side where we're just, where you're trading, maybe something like you're trading a demo. You've got to get it to the point, I think, where you're increasing the size so that you feel like you're trading well. One trader put it brilliantly. I think this is, I'll paraphrase a bit. You're on here. I feel like I'm in the playground. It doesn't matter so much. I wanted to be an adult, think more clearly about this and more carefully about the decision making. So I'm going to increase my size a little bit strategically to help me kind of be more dialed in. So a quick word on sizing up here. Listen, I want you to think of it as a commercial decision. You are the CEO of your trading business, right? You are treating this with the respect it deserves, right? You are allocating risk capital. Now, maybe you're scalping many times a day. You're still allocating risk capital. You're still imagining yourself, hey, these are the resources I've got. And it doesn't matter what those resources are. Could be 300 quid. It doesn't matter. You're allocating those resources. You're heading somewhere else. So you've got to think of it as if it was a couple of 100 million, right? Allocating those resources is a commercial decision, and understanding the pros and cons that come with that. You might say, hey, I want to trade 4 times the risk on this day because this is great, it's working out great for me, I'm in tune, I want to increase the size. But a CEO would say, what's the downside? Well, the downside is if I get it wrong, I'm going to be 4 times as much in damage. Am I prepared to accept that risk, that trade-off? And again, thinking clearly without emotion polluting the decision, yes, I am. I believe that I believe, but we rewind a moment. I accept the downside that comes with that. The upside is this, the downside is this. I believe on balance, it's worth me risking more in this trade, this week, this day, this sequence, because I think the upside is going to outweigh. Now, I could be wrong, and this is my risk, but do I accept the ups and downs that come with that? Do I accept the pros and cons would come with that? If you do, then anything you do in risk and anything you do with adjusting risk is a commercial decision. And that's why a lot of traders stagnate a bit. They stick with the same risk and they kind of fall into this rut. And actually, even though you might choose to stay in the same trading size, I think it makes sense to step back and go, I am trading this size this week, this month, this quarter, this trading sequence because of X, Y, Z. And making it more of a commercial decision for you. And then you can adjust it up and down if you choose to or not. But it's intentional. Intentionality is such a powerful thing in trading. All right, so let's summarize what we covered today. 1, psychology and emotion, adjusting for your mental state and confidence levels. If you feel like dog, you know what, and things aren't going your way, then just a little tweak. It doesn't have to be a massive tweak. Could be fine. You might want to adjust it right down and go, you know what, and that's absolutely fine as well. If you say, do you know what, I just can't do anything, I need to reduce it, take 90% size off for all I care, do what you need to do. It's a tool to use, but you might just want to go a little 10%er just to kind of get the confidence back and feel like you're being proactive. You make that call. Your money, your risk. Second one, performance metrics. The data is basically saying, hey, I'm not doing very well, I'm going to adjust the size based on that. Third one, market regime. Not an obvious always, not always so obvious. As I said, don't get a flag that goes market regime is changing, I need to do this. But you know as well as I do, you're like, hey, this is not doing what I want. I like to hold for multi-days. I like to hold for multi-days as well. We're not getting multi-day moves on the Nasdaq. We're not getting multi-day moves. Okay, so do I want to do? Do I want to adjust my strategy and just do A to B? That's fine. You can just do that, adjust your strategy. Or do you want to dial the size down and keep what you're doing, but you're just going to kind of reduce it a little bit because you don't want to miss out when it comes back in? Again, commercial decision, intentionality to it. And the final thing, the quality of the setups. If you're doing it on an individual basis or a strategy bucket basis, you can adjust the size based on the conviction you've got. And again, be careful, please be careful. The decision is not polluted with emotion. There's too many traders who've thought, this is the one, man, this is going to make me loads of money, piling loads of chips in. And it was purely from a perspective of FOMO. It was purely from a perspective of trying to get back recent losses. It was a gambling, it was a frustration. Be very careful. If you have any chinks in your discipline armor, do not do that. Do not adjust your size on the fly if there is any element of discipline. There's plenty more things you can do without adding this pressure, because the trader who has discipline issues will absolutely lose and go, you know what, this is a grade A setup, ramp the size right up, and they're in the business of trying to recover the loss as opposed to actually doing it from a commercial intentional situation. So just a little warning there, and I really want to push that home because I see too many traders who do have that. And it's fine. You work on your discipline issues. There's other levers you can pull without having the pressure of adjusting size midway through the trade. So there's that. Right. Other thing is the segments. If you've got segments, what do you rate the segments? Is it based on data? Is it based on, you know, how you perform, the regime, all the stuff, and then you adjust the size based on the segment or the bucket that the trading setup is in. Wow, that's it. Okay. Good timing. Good timing. Any questions, guys? I'm happy to take them. I love this sort of topic. Risk, sizing, increasing size is great. Whilst you are adding your questions to the chat, thank you to Pepperstone, of course, for partnering with me on this. Go and explore their website. Go and check them out. Check out the spreads. Check out the platforms. Yada, yada, yada. See if they are a broker you would like to do some business with. Okay, so next month, we are in the final month of the 12-week Traders Operating System. We're talking about consistency and longevity. So putting all this together, operating like a trader, not a gambler. Some of the skills. So next week, talking about some of the skills that help create consistency, and they're not always the obvious ones as well. So I'll share with you some things that I think to help you with that. Development phases, so different phases we go through as traders, and how to kind of know when to step back and know when to consolidate an individual phase, and what resources and things to pull in to kind of you really firm up the phase, lay the foundation to go to the next one so you don't crumble right back to square one all the time. Trader identity and self-sabotage, a little bit of psychology here, and then wrapping it all up by building your own Traders Operating System. So running through, reminding ourselves of the strategies, the decision-making process, the development, all the stuff, bring it together so that hopefully you can really move your trading forward. That's what I want for you, to really improve your trading. Okay, let me get the mouse. If you have some questions, I will take them. If you don't, then we'll call it an evening there. Let me zip that out. Let me bring you over here. Okay. How often, this is Zach, how often do regimes change, etc.? Sometimes like, let me click this, sorry, Zach. How often do regimes change, etc.? Sometimes, like recently, I don't know what the regime is. Zach, they can change from week to week, month to month, year to year, even day to day. You might have a day that's really trending and then just sits there and does nothing. That doesn't help you, me saying that. But the best way to it's basically charting, right? Regimes are a fancy way of saying what is happening with price. Is it oscillating in a range? Is it breaking out and exploring fresh territory? Is it volatile and whip and news based? You can imagine we had a day for trading during the Trump tariff thing, very volatile, very headline based, very driven by news. That's the regime you're in. You kind of had to be in. You didn't want to overstay your welcome. You overstayed your welcome, some sort of headline could come out, a very specific regime. And we kind of had that bounce off the tariff low last year, and everyone was piling back into an oversold market. Regime was price exploration, trending, uptrending, moving to new highs. That was the structure you're in. And then you kind of look now, the S&P 500 at the start of the year, it's not done anything. It's just sat there, and I would say we're in a kind of two-way market regime, mean reversion type regime. So you get that on a daily chart. That'd be a daily chart regime, and then intraday you would look at it and say, hey, or maybe put 2 or 3 days together and say, hey, with a big trend day yesterday, today we're just consolidating. So I'm not going to try and be buying breakouts again that was working yesterday. Today the regime shifted, so I might want to back off. And in that case, I wouldn't even be doing the size adjustment. I just wouldn't be trading breakouts. But sometimes it's not so obvious. So, you have to put a label on it per se, but just kind of look at the market. And a good way to do this, Zach, is to go through and kind of look at the chart that you like to trade and draw a horizontal line or a rectangle and say, this is a kind of price exploration regime. This is a congestion regime. Whatever label you put on it. Some guys put other labels and names on it. It doesn't really matter. But just distinguishing the difference, and then if you want to really do some homework and go even deeper, you can then look and see if there was any reason why we shifted. Was it the start of a month? Was it some sort of news event, some sort of catalyst? Was it some kind of price to highs or whatever it might be? Hopefully that's helped, pal. Right. Ruben says, how do you differentiate between temporary drawdown and structural breakdown of a strategy? Yeah, we talked about this. I thought, was it last week we talked about this? I'm not sure if we did, but this is a good question. And honestly, it's not easy. I'm going to be frank with you, mate. It's not easy. You don't know for sure. You don't know for sure. And if we did, it'd be perfect, because you just go, oh, that's a strategy. It's not working. I'm going to stop. And, honestly, that's one of the skills to develop as a trader, is to say, and there's never going to get it perfectly right either. I'm not here to say once you get it, you'll be perfect. No. Sometimes it's just the expected drawdown of a trade. And you can look in history and you can look at back tests, or like if you're kind of eyeballing the stuff, or you've got data, you've got your own track record to look at, you can kind of look and say, this doesn't feel like normal. Or you can just trust your judgment and gut and say, hey, the regime looks, the market I'm trading now is not the market I was trading when it was working. Look, and often that's the higher time frame chart, whatever asset class you're trading, higher time frame chart. You look at that, you mirror it onto when it was working, and go, look, it looks structurally different. That's probably the reason why. And so, it's kind of judgment of saying, okay, what do I expect my drawdown to be? How long do I expect my losing streaks to be? Then you look at the kind of overlay the chart on top of it and do that. Hope that's helped. All right, a couple more questions here. We've got Zach says, thank you. Appreciate you, Zach. Appreciate all of you attending, guys. I do. Thank you so much. Toby. Brilliant stuff as always, Mark. Thank you, Toby. I recently listened to your podcast episode with Trader Tom, and this topic fits perfectly with the goal of managing risk when adding winners. Adding to winners you discussed. Very valuable stuff. You know what? Tom is very, very good at that, or at least I don't know if he still trades that way. I assume he does. No reason to change something if it's working, right? And you're right. I've got a podcast episode. I think if you type in his name, you go to Traders Mastermind, either on Spotify or my website. which is tradersmastermind.com, you can find it. Actually, yeah, he put in Tom Hugard into Spotify. I think it's the second one that comes up. Yeah, it was a good conversation with Tom, that. Really good. And his book. That one? That one. Where is it? Where's his book? Yeah, Best Loser Wins. Yeah, and he's a big advocate of adding size, and he does it a lot from the mental perspective as well. It's like, I feel fear and I want to, not he used to say this, I feel fear and I want to do the opposite of what most people do, which is getting out of position. Jacob says, how to avoid God mode. I've identified a pattern in my trading. Looks like this: after a winning streak, I oversized, then profits from my previous trade disappear. You have to, I feel you on this, Jacob. I feel you. This is something that you just have to recognize the signs, right? And the signs are, like you said, a winning streak. And so you must, when you come into the trading day, be mindful of that. Visualize yourself not increasing size on a whim, not believing you are untouchable, not believing any of that, and saying, listen, I'm not making this mistake again. I'm keeping these gains. You know, any trader can make a lot of money, losing money. It's not what you want to do. You want to make it, keep it, give as little back as possible, make another leg, make another leg. That's the name of the game. And so you need to do some mental work and say, hey, the signal is a winning streak. If I see a winning streak, I need to be careful I don't go into God mode. Okay, fine. And remind yourself of that, reinforce that, visualize that, do all the mental work that you need to do so that you don't fall into that pattern. It's fixable, but you just have to be aware of it. So the signals, which is probably the winning streak, or anything else, great trade could be one great day, anything that turns you into, I've got this cracked, go, whoa, hang on a second, my warning sign, I need to now make sure that I do not, under any circumstances, oversize stuff. Panos. Hi, Mark. How you doing, Panos? Do you think increasing or decreasing your size after a loser or winner is better than having a fixed risk percentage based on your balance? I don't think there's no right or wrong for this, Panos. I definitely wouldn't be increasing my size after a loser. I know it's not what you said. And I wouldn't be making minor adjustments all the time. If I had a losing trade, it's got to be a pattern, right? And it's a commercial decision for you to say. So if you're trading a fixed percentage of your balance and you say, oh, I'm trading 1%, 2%, 3%, 5%, whatever number, your choice, your money, your call, you just make that decision and go, well, today I'm trading 1% and the rest of the week I'm trading 1%. Oh, the regime shifted and I've been doing all right. Maybe I'm going to increase it to 1.25. If you have a history of making big adjustments to size and it not working, then try smaller adjustments. So, let's say you did like 2%, instead of going to 3%, go to 2.25 or 2.5. You just make these minor adjustments when you think that things are, got potential to work in your favor. That could be up or down. Paul. Hello, Paul. Thank you. Always interesting in bringing to light many thoughts you don't always consider. Appreciate that, pal. Thank you, Mark. Ruben, feedback on that answer. Okay. How do I pronounce your name, pal? I'm going to have a go. Always have a go. I always like to have a go. Gili Ume. Yeah, I don't know. Maybe close. Someone's probably laughing, going, how do you not know that name? It's like, yeah. Cheers for your question, mate. Right, let's have a look. I'm currently testing a new strategy. I completed both back testing and forward testing with good results. However, when I went live this week, the very first day resulted in consecutive losses. That is the nature of the beast. It always seems to do that. I thought I was comfortable with the position size, but the back-to-back losses affected me more than I expected. Okay, the next day performance returned to normal, but I struggled to hold my positions properly. I kept cutting winners short and left a lot on the table. This is classic, mate. Everyone does this. That you're not alone here. Today I decided to reduce my position size significantly because I realized it was impacting my performance and decision making. Good for being proactive. One little idea to help you if you are taking a new strategy live or doing something new. Sometimes that's increasing size, new strategy live, whatever it is to not be so focused and put so much weight on the outcome of the individual trade, because you're like, oh, I'm all prepared. I've done my back test, number 4 testing. Right, here we go. Click, and it's all a big event, and you've built it up in your mind, and you're really excited about it and stuff. And then so the first trade losing, just go, oh, it makes you feel awful. The second, forget that. Commit to doing a chunk of trades and say, I'm going to trade this new strategy for 20 trades, for 30 trades, 10 trades, whatever number makes sense to you. And I do not care about the results of each individual trade. Make that a real kind of embed it in your skull and say, I don't care about each individual trade. I'm going to trade this for a period of time, and then I'm going to review the results. Because the problem you have is common with many traders, right? Is that you go, oh, it's a big deal, I'm going to trade more size this week, or I've got a new plan or a new strategy. And you go into it and you're so fired up, and then the loses and you feel so despondent. You've got to commit to doing it for a period of time before you do the review. That will help your brain kind of make sense of stuff. All right, let's run through a few more questions and we'll call it an evening. Andy says, thanks so much again, Mark. Very interesting. Appreciate that, Andy. Glad you guys are liking this one. Question, when do you increase size again? Is there a route to avoid revenge sizing? Oh, sorry, is there a rule to avoid revenge sizing? Self-awareness, Andy. Trading is very, very much a game of being self-aware. If you can recognize when you feel those emotions of, I want to get this back. And that's why I was very, very mindful of saying, don't increase size if you have any chinks. Revenge trading is a massive one, because you're like, oh, I'm allowed to increase size. Of course, you're going to increase size after you lost, because it's a quicker way to get your money back, right? And then it gets worse and worse and worse. Do not ever do that. It's being self-aware enough to know, hey, I don't feel so good about this. I'm feeling that I want to get the money back, as opposed to seeing a trade I like, a setup I like, understanding the ups and downs and pros and cons with it, and taking it clearly from a logical and kind of operational perspective. So just be mindful of that, Andy. Is just so the answer, I think, is just being self-aware, journaling your thoughts, all this type of stuff. Mark says, if you're trading at a prop firm like SMB and increase your stake substantially and lose, you would get refunded. If you increase your A+ and take a big rip on your personal account, it could wipe you out. Yeah, absolutely. Yeah, that's the decision you make. And so if that's not for you, don't take it. You have to understand that that's the downside. There's no magic upside here. That's why I say it's a commercial decision, right? But they're making a commercial decision as well. They're recognizing the trader. They're saying, hey, you know what? Mark does very well at this. I want to push more size, because he's an asset to the business. I'm going to push in more size, and they will take the hit themselves, or a company will, if it doesn't work. So someone is still making that commercial decision. You are just now the company, and you're the trader as well. So you decide, am I prepared to take a big hit on this? And it's not too big, by the way. You can still say, well, it's more than I normally would, but it's still manageable. You never want to be in a situation where it hurts so much. You might say, you know what, I'm prepared to allocate more risk capital to this, because I think this has got a higher positive expectancy, but I understand if it doesn't, it's not going to hurt me. You should still always be thinking like that. How to know when in a bull or bear market? You know the answers to that, Zach. And Ruben says, what metrics you prioritize? VAR, CVR, max drawdown, sharp on white. I don't, you know what, that neck of the woods is more for kind of, I think, portfolio managing and stuff. And I know that Schwager talks a little bit about sharp and Sortino ratio and all this type of stuff. In the day, I think capital's a tool. How much you have in your account may not be representative of the amount you've got at risk. You might just put in your account the number that you need to trade, the margin requirements, the drawdown, etc. So I'm more of a kind of looser trader in terms of, hey, I just want to look and I want to see how I feel about the drawdown. What are the numbers looking like? Looking at these kind of metrics, fine. If it works for you, then great. Or eyeball works for you. I think at the end of the day, mate, if you feel something, doesn't matter what the number says, then if the number says, hey, you can risk this, your value at risk should be this, and you feel uncomfortable doing it, you're never going to want to do it. Or if you look at that value at risk and say, oh, I'm going to do this, I'm going to trade, this specific formula to work out my position sizing and stuff, and you're like, well, that's not going to get me where my goals. My goals are to try and do more, and I'm prepared to take the downside with that. I'm prepared to take a bit more risk. Then, that's the decision for you to make. I think go into that when you kind of have a bigger portfolio size. Okay, let's whiz through these. Jacob says, thanks for answering my question. I have one more thing. How to avoid a capped account. For example, I passed a 10K funded account. I applied this strategy under account, burn it. This felt emotional pressure trading such size account. Example, I passed the 10K from the account when I applied the same strategy. Okay, so if we're talking from a position sizing perspective here, you don't have to trade. You know, if you have a 100K account or a 10K account, you don't have to trade 10 times the size. Now, sure, you want to get to the point where if you've worked on a 10K account, it would work 10 times as much for a 100K account. Well, there's a psychological hurdle to get over. Trade as you were on a 10K, the same size, and work it up slowly. Just go, don't make it a big deal. So when you do that and you shift, you say, okay, nothing's changed. The numbers just changed. I'm not going to adjust the size, and then work up slowly. It's very difficult sometimes to go 10 times the size on something because the numbers suddenly changes. You kind of calibrate into different numbers moving on the screen if you've got your P&L up, which debatable whether you should. Think about doing that. Just do exactly what you were doing with the 4, with the 10. Now you're in 100, and then slowly bring that size up. Thanks for the input, says Erastus. Appreciate you, pal. Okay, 2 more questions. I'll get to these last 2 things. Anthony says, hello, Mark. Great session. Thank you, Anthony. It seems like trading does a lot what self-help type people try to accomplish. Emotional control, self-knowledge, awareness. It absolutely does. That's the name of the game. It's, you know, if you're trading a discretionary trader, which you probably are, the number 1 factor is how we control ourselves under certain conditions and recognizing emotions. We can't emotional control, yeah, but we can't control the emotions we feel. We just have to make sure they don't pollute our trading decisions. Massive whole topic, but absolutely that is the case. Arthi, how you doing, Arthi? Any thoughts on whether it's better to increase size on a single entry versus increase size risk by allowing yourself more tries at the trade? You know what? I think the single entry, if you can, because you kind of reward yourself for being, you know, it's a different question, isn't it? Because you reward yourself, if you're not careful, you're rewarding yourself. You're thinking to yourself, oh, if I get this wrong, I can always have another bite of the cherry. But if you don't reward yourself for getting it right, because if you get it right first time, you're like, oh, I could have allocated the size I had for doing 2 or 3 bites of the cherry or 3 goes of that sequence on this trade would have made 3 times as much. I think they're separate things and look at them separately. So, you know, maybe you look at it as different questions. This is my risk allocation per trade on this, and these are the trades I've allowed 2 goes at versus the trade I'm only allowed 1 go out or 3 goes, whatever it might be, and you think of it differently. I think that if you muddle those 2 up, then you're kind of rewarding you're not rewarding good trading, if that makes sense. Leslie, thanks for this lesson. Mark, looking forward to next month. Me too, Leslie, me too. Same time, same place, guys. I will be here next, forgot the day, Tuesday, 7 o'clock UK time. I don't think the clocks go for a while yet, so we're still on 7 o'clock. Thank you very much, ladies and gents. Appreciate you all. Overrun a little bit, but hopefully you have enjoyed this one. Thank you, Marinus. Thank you, everybody. Appreciate you all. We shall see you next week. Take care. Get risk managed. Bye-bye.